Good afternoon, everyone. My name is Travis Escobar. I'm the founder and board chair of Millennial Rhode Island, and I'm excited to bring to you today our stock investing 101 workshop with BankNewport. BankNewport has been a tremendous partner with Millennial Rhode Island over the past few years, educating young professionals on financial literacy. Investing has been something that has been brought up for many of our members, many people within the community, to see, how, if they are fortunate enough to have funding, how can they use that to either save for retirement or save for other big purchases down the line within their personal life, and to bring more financial security to them in the state of Rhode Island. So BankNewport has been such a great partner with us to do that. And during the pandemic, there's actually been a rise of millennials looking into stock investing, looking into applications such as Robinhood and other such mobile applications that they're looking to take their funds and invest in stocks for a better financial security. So we wanted to bring important information, because if you're just jumping into stock investing and you might not have the basic knowledge, you might end up with a lot of pain. You might end up with some financial losses, unfortunately. So we want to make sure that you are prepared as much as possible, and that's why we're bringing this workshop here today. So with that, I'm going to go and pass it to our expert, Sherry Hendricks, who is a financial advisor with Ocean Point Investment Solutions and works with BankNewport. Thank you so much, Sherry Hendricks, for coming over here and presenting and giving us vital information on how to better invest finances if we're have it, for privilege to have it. So thank you, Sherry, and you'll take it away from here.
All right, excellent. Well, thank you so much, Travis, for that introduction. So I'm here today. I was asked to actually speak about a lot of the online applications, as well as some of your other options as far as investments go. So I'm going to start with my presentation, and I will go through it, and we will then end it with some open questioning. If you have any questions for me, feel free to ask. So we'll start today, and here we go. All right, so the first thing I'd like to do is introduce myself. My name is Sherry Hendricks. I am a financial advisor with Ocean Point Investment Solutions. I work through BankNewport, and I work actually in 10 different branches. And I help our clients and customers plan for savings, investing, and eventually toward retirement. So as far as today goes, the world today, I should say, it's changed a lot. And investing has become something that people can do on their own. They can do it from home, and they can do it through technology. And there's also a lot more resources as far as people willing and able to help the average person be able to purchase stock, mutual funds, ETFs, bonds, etc. So there are many ways that you could go about starting your investment process. And so I'm going to start by talking about today's investments, or investing, and how humans and technology can create better financial lives for everyone. So some of the options that you have in the different platforms you can tie into in order to start your investing. The first one, which is very common, that people talk about a lot, or is advertised on the TV all the time, the radio, is the zero cost trading, where you can purchase your own stocks, whether it be online or even on an app on your phone. And you can purchase stocks on your own through applications such as Robinhood, SoFi, Stash, E-Trade, and Acorn, among many others. There's also something called a digital advisor, and that's what we wanted to really talk today about, because it kind of ties together. It's like a hybrid, and it allows you to invest on your own, but it also many times will come along with some guidance, as well as putting together a portfolio that is based on your own needs, risk tolerance, time horizon, and what some of your financial goals are. These robo-advisors or digital advisors are typically driven by artificial intelligence. The artificial intelligence is based on basically answers that you give while taking a questionnaire that will allow us to know what's important to you. And it will plug it into an algorithm that will create a tailored portfolio specific to your needs and your risk tolerance. What's nice is some of these actual robo-advisors also include personal coaching or guidance, such as we have here at BankNewport, something called Guided Wealth Portfolio. Betterment is another application that offers advisors that you can speak with for guidance, such as a coach, as does Charles Schwab and Fidelity. The last way, obviously, that people are all aware of is a traditional financial advisor. This tends to be more of a hands-off approach where someone just trusts their money to an advisor and they just want to meet with them several times a year just to review and make sure that what they currently have in place is still supporting their needs. So I have this little clip here, and it will tell you a little bit more about what a robo-advisor is for anyone who's unclear on what it actually means.
Since their launch just a few years ago, so-called robo-advisors have been entrusted with billions of dollars by many different kinds of investors. So what exactly are robo-advisors? Despite the name, robo-advisors aren't actually robots. They're sophisticated and use advanced algorithms designed to take strategies developed by human investment advisors and share them with everyone. Because they're automated, robo-advisors tend to be cheap and easy to use, making them an attractive option for all kinds of investors, from young people just starting out to more established investors, like retirees looking for help generating income.
So how do robo-advisors work? So this first step is to sit down, and typically us at BankNewport, when we work with people who want to set up a guided wealth portfolio, we sit down with them and help them to complete a comprehensive online questionnaire. And it will include questions that have to do with their specific needs, their goals, some of their risk tolerance, and see what it is that you're looking to do and invest in. The robo-advisor platform would then process what we input using algorithms that will help to tailor that solution for that person or that client. We would continue to meet several times a year to review and look at what some of those goals might be and to see if we need to basically switch them up a little bit depending on what's going on in your life. This will help you to save for particular goals, whether it be to pay down student loans, to save up for your first home. Maybe you have a family and you're looking to save up for a trip or your children's education. But there are many goals that we have throughout our life. And by sitting down with somebody who could coach you, you could help set those goals in motion and figure out what we're going to be working toward. So this algorithm that's built in can be adjusted through time as your times and needs change. So some of the tips that are very important that will help you to choose which robo-advisor to use. The first one is to know your goals. By knowing your goals, this would help you plan to know what kind of time horizon you have, which in turn would typically judge how risky you want to be. Typically, if you have a long-term goal, we can create a diversified portfolio that would grow over time. Whereas if it's a short-term goal, you want to make sure you keep it a little bit more conservative. The next step would be to facilitate goal planning. So instead of picking a particular goal, actually setting up a schedule as far as multiple goals and a timeline that you're looking to achieve those in. The other thing is when choosing a robo-advisor, make sure that you understand the fees and the minimum amounts you need to put into the account to actually start an account. Fees sometimes can be surprising. Some of the zero cost, low cost, cheap robo-advisors are not necessarily as cheap as they sound. Sometimes there's some hidden fees whether it be for the management of those assets or underlying fees in mutual funds, ETFs, and other sources where there are management involved. It's important to review the support staff and their credentials. So all robo-advisors do have coaches that might help you, but it's very important to make sure they're fully licensed through our agency called FINRA, and that they are actually considered fiduciaries. A licensed fiduciary is someone who is licensed through FINRA to be a fiduciary, which means they are looking out for your best interest. They're not working for the bank in the bank's interest, and they're not selling you stuff to generate any kind of commissions or income off of you. Their goal there is set to make sure that whatever is put in place for you is supporting your goals and needs. Another thing that's important is check the ease of access. In other words, make sure that app is easy to use, that you can access a portal where you can see what you have in your investment account and how it's performing. In order to have one that works best for you, you need to access it. So make sure there is a lot of it's an easy to use platform. Another thing that's important is to dive into all of what they have to offer. Different people have different ideas as far as what they want to do to invest. Some people just want to set it and forget it and create a diversified portfolio of either ETFs or mutual funds, while others want to be able to move things around regularly. So you want to make sure that whatever robo-advisor platform you choose, you can access the type of funds and the ability to do different things. For example, I know Robinhood allows you to not only set up a portfolio, but I believe you can set things up such as you can purchase options, you can go in on margins, and this is very advanced for a robo-advisor. But if that's something you're looking for, you want to make sure that whichever one you choose is able to do whatever it is that you're looking to do. And lastly, what's important is to know when you've outgrown that robo-advisor. It's not necessarily always the right solution for everyone. And as your assets start to grow, and perhaps your family starts to grow and some of your goals get bigger and tax planning becomes an issue, you may want to sit down with a professional who can actually outline a financial plan for you so that you basically have a roadmap to success. So some of the best robo-advisors of 2020, after doing some of my research, are as follows. Betterment was known for its great service, and everything I read up on it said that Betterment offered great advice, coaching, guidance, etc., if that was the plan that you signed up for. The one thing you want to be careful of, though, is if you sign up for the plan that includes guidance and coaching, typically there is a fee involved in that, which is different than just doing it on your own and purchasing and selling stock. Wealthfront is also a great one. It's known for its low fees, but that one is almost completely self-driven. So with that one, you won't get much input, you won't get much help, but if all you want to do is go on, purchase, sell, do whatever you want with what you have on your own, feel free to use Wealthfront. It's a very good platform that allows you to do a lot of things, but again, all on your own with very little guidance. EllisVest is great for goal-based investing. They will help you set up a plan, a basic plan, not probably as advanced as maybe if you sat down with a professional, but a pretty good way to map out a course of meeting different goals that you're planning out for yourself and how your investments can actually fund those goals. SoFi is a great one for playing with. You can learn a lot from it. It's great for educational purposes. You could even use it to even teach maybe, a niece, a nephew, or a child, middle school age, just what the market is, how it works. So it's kind of a fun one to play with and a good one for showing people how to go about investing in the market on a basic level. Now, the guided wealth portfolios are what we offer here at BankNewport. Schwab has their own platform, as does Fidelity. And these are great because they are good for the do-it-yourselfer who likes to have some hands-on with their investments, but also includes a professional coach that you will build a relationship with along the way. So it's not a 1-800 number the way you would maybe with a Betterment or one of the other online apps. Instead, you actually could sit down with a professional in their office with your statements and go over different things and have some of your questions answered as far as your investments, but you're also able to do a lot yourself with your online portal. So here's another clip that's just going to go into a little bit about how it might be a better way to invest for some. And what's nice about it, robo-advising has enabled a lot more people to get involved in the market and to understand the market.
Robo-advisors take many tedious tasks off the hands of investors. In the past, if you wanted to build a diversified portfolio of investments geared towards your time frame and sensitivity to risk, but didn't want to work with a professional advisor, you had to handle the research, pick the investments, and do all the buying and selling yourself. Maintaining your portfolio also meant monitoring it regularly to keep everything on track as the markets changed. You also had to decide whether or when to harvest losses to offset taxable gains elsewhere in your portfolio.
I'm sorry about that.
To build a diversified portfolio of investments geared towards your time frame and sensitivity to risk, but didn't want to work with a professional advisor, you had to handle the research, pick the investments, and do all the buying and selling yourself. Maintaining your portfolio also meant monitoring it regularly to keep everything on track as the markets changed. You also had to decide whether or when to harvest losses to offset taxable gains elsewhere in your portfolio. This took time, not only time to manage the portfolio, but time to develop investment strategies and expertise. Now, robo-advisors can do most of this for you, breaking down old barriers of time, knowledge, affordability, and access to put sophisticated investing advice, research, and monitoring into the hands of many.
So humans, technology, and better financial lives. So today's investor has many options that we covered when it comes to gaining financial advice. There are apps, there are brokers, robos, blogs, and traditional advisors. We are in an era where traditional advisory firms are adding tons of technology. There are many choices of online platforms, and robo-advisors are adding more investors daily. So here at BankNewport and Ocean Point Investment Solutions, we like to work with our clients and help them to figure out what some of their goals are and best ways of achieving them. This is a little bit about the guided wealth portfolio, which is the robo-advisor that we work with. Anyone using this would be assigned an advisor, whether it be me or my partner, Don, and you would be able to manage your own at home online, but have access to us anytime you needed it. So I'll just show you a little bit about what we have on our platform, how it works, and then I'll field any kind of questions that you may have.
Are you looking to start investing or change your current investment strategy? Do you like the idea of 24/7 online access to your accounts, but also want access to a human financial advisor? Guided Wealth Portfolios could be a good solution for you. Guided Wealth Portfolios, or GWP, can help you invest for your future today by combining digital technology with a personal one-on-one relationship with a financial advisor. Unlike many other robo-advisor solutions that require a high starting investment amount if you'd like an advisor relationship, GWP gives you access to an individual financial advisor for a beginning investment of only $5,000. This means you can call your advisor if you have a question about your investments, while still enjoying easy online access to your accounts. GWP also presents expanded opportunities to help you build toward your financial goals. You receive an investment portfolio designed specifically for your place in life and financial objectives, filled with lower cost funds and built by experienced professional money managers. The GWP algorithm places your money in a smart, tax-efficient way and analyzes your account on a daily basis for opportunities to potentially reduce your taxes and update your portfolio to keep it in line with your goals. To help GWP and your advisor determine the right strategy for you, you'll go to GWP and provide some basic information about you, your goals, and your preferred investment style. You can also link any existing accounts or enter how much you'd like to invest to get a personalized proposal. To learn more and get your personalized proposal, contact your financial advisor today.
So do we have any questions?
Yeah, so thank you so much again, Sherry, for your presentation. For anyone who is watching us, online, feel free to ask questions on the comments. But Sherry, I definitely have a couple of questions I'd like to ask you. Just as someone who has gotten questions from other friends who started investing, or I've even thought about investing myself. Sherry, when's sort of the best time for young people to invest, right? So the millennial generation, a lot of us have student loan debt. Good chunk of us would have sort of credit card debt. Is there sort of an aspect before someone gets into investing, and I'm talking about separate from starting a retirement account, which is extremely important if you can, especially if an employer can match, right, and invest also with you. But yeah, what would sort of be the good time for someone to invest additional dollars if they have it? Like, should one look at their debt ratio before looking to do that?
Well, I would say definitely. I mean, as far as your retirement savings, because you have an employer match, I mean, that's something you never turn down because that's free money. As far as if you want to invest on your own, as far as timing, I would say if you're working, you're in either your first or second job and you're starting to save some money, the next step or next place I think would be ideal would be putting it into something called a Roth IRA. A Roth IRA is investing in the market, just as opening up your own portfolio. But what's nice about a Roth IRA is there are no taxes on any of that growth at the time that you retire and take that out. So that's a very important asset or supplement to what you're currently putting away in your 401k. So that's a good place to go next. As far as an actual investment account to grow, to save toward particular goals, I understand you may be saving to try and pay down student loans first, or maybe save up for that first home that you want to put a down payment on. Sometimes by working with investments, whether it be with a professional, advisor one-on-one, or if you wanted to start your own through a RoboAdvisor, it may be a good way to grow assets, stay ahead of inflation, and try and use it to pay down some of those student loans, or possibly to save up to put a down payment on a home. It depends on what those goals are and how you feel about the market. But many times the market will produce a lot more than if you were just putting money toward especially student loans, which tend to be at lower interest rates. If you have high interest rate credit cards, I say get rid of those first. You're just losing so much in interest at that point. Does that answer your question, Travis?
Yes. I'm actually gonna follow up. So I see one of the questions from Lisa, and basically asking how much money a person should have to save to be available to invest. And what I'm hearing from you, Sherry, is that it's dependent on it's not a specific amount potentially, but it's dependent on what sort of financial situation you're in, and to sort of clear as much of your debt as possible, especially if they're high interest credit cards, before looking at investing. But right. I would also, so I guess a question I would have, let's say someone's in that particular position and they have $500 to invest. Does that matter, or should someone create a plan where they're looking to treat investment similar to a savings account where you're looking to put more money in potentially to a safe portfolio, maybe not something that's risky.
Understood. Yeah. So honestly, I have a lot of clients that like to put away money similar to the way, like if you had your own when you were young, a Christmas fund or a vacation fund. And so what I have clients that will, as far as just a separate account as a savings, what they'll do is sometimes just start it with say $500, and then they may add in, $30 a month to it, which doesn't sound like much. But when it's being invested into a diversified portfolio, over time it will grow. And the interest that is gained over the market versus if it was sitting in a savings account is great. And so sometimes it's kind of like your 401k money. You have deductions coming out. So therefore you don't miss it because you didn't see it. So it's a similar idea. Some people will put it on auto. And that way, what's nice is it takes advantage of what we call dollar cost averaging, which means if the same amount is given every month, sometimes you're buying the market low, sometimes you're buying it higher, but you're always able to beat the markets as far as what your outgo is, as opposed to trying to be a day trader and time it. So I find for younger people to just start with a small amount, maybe a portion of your tax return, come April when you get a check in the mail. That's how I've had a lot of people start accounts and end up with much greater in assets than they even realized, when they don't realize that there's just $30 or $50 coming out monthly. It does accrue, and it's kind of nice to have as a separate account.
Great. Thank you so much, Sherry, for that. We actually have a question from Kyle Peckett, who is our executive director for Millennial Rhode Island. She asked, if we choose to invest via an app, what are the best practices for choosing which stocks to invest in? And I'll add on to that. So I know stocks like Robinhood, they'll give you, the top 25 popular. They'll give you, sort of a list of what's doing really well and what's going bad. And maybe some beginners might choose stocks that are, all right, hey, this stock went up 10%. Let me go on that. But then you could chase the stock and lose money. So what sort of advice would you have, I guess, in terms of researching stocks to invest in?
Understood. So now, as far as stocks go and trading on Robinhood, to trade individual stocks is very risky for anyone. So anyone who's putting money into Robinhood or any of those other online trading where you're buying individual stocks, research is good, but at the end of the day, that one company has something hit it and you could lose. So as far as day trading, it's a risky business. So the money that you do it with needs to be money that you're willing to know you could lose. But it's fun and you can learn. And I know a lot of the younger bankers I talk to really love playing with it, with Robinhood, and they've learned so much. They're talking about, they put stop losses on some of their stuff, and they've got options available to them, and they've got, and so it's a great place and a way to learn. But I wouldn't put my retirement monies into a Robinhood, nor would I put it into probably individual stocks too much. Typically through mutual funds, they're professionally managed, and you have the ability to diversify. And through diversification, you pretty much limit your losses. Does that answer your question?
Yes. Thank you. And I'm going to go to another question from the comments. Olansky Luciano, hopefully I said that first name correctly, but can you have, so they ask, can you have multiple Roth IRA accounts?
You can, yes. But you can only contribute a certain amount per year. So for anyone under the age of 50, the limit is $6,000 per year. So you can put $6,000 into a Roth account per year. If you have two separate ones, maybe you have one that you manage on your own through a Robinhood or any of the other online apps, and then maybe you have another one at your bank or with a financial advisor. You can have multiples. It's just that you can only put in a certain amount per year combined.
Thank you. And I'm going to go to a question from Johan Vallejo. He asked, can you explain how options work. Again, I think, especially with the Robinhood app, I saw it was a pretty viral article talking about the dangers of options. Someone had an unfortunate incident regarding to options, and I know, and I know there's also extensive tutorials out there around options. I wonder if there's sort of a brief overview, Sherry, that you can explain about options, and also maybe some of the dangers about it as well.
Sure. I mean, I don't probably won't go into too much detail about options, but they're risky, and it isn't something I would typically suggest the average daily person just playing utilize. So when you start trading with options and margins, you're talking about some advanced measures. And I know there were a lot of issues on Robinhood, and their system basically crashed because it wasn't really the network or the server couldn't handle the amount of traffic that went on. So basically what had happened, from what I understand, about 4 weeks ago, when the market basically took a downturn for the worse due to COVID, people had put on stop loss onto a lot of their accounts, which means that they're going to sell a particular stock or a group of stocks that they own if the price of that particular stock or what have you went down, or when it hits a certain price. So what had happened was, I guess a lot of the Robinhood investors had put those stop losses on their accounts to protect their gains and protect them from downside losses. And unfortunately, when the stock market did a huge crash about, I think it was three and a half weeks ago, all the stop losses kicked in at the same time, and basically the platform froze. The server couldn't handle it. And so the actual trading never took place. So I don't know what's going to happen with that, if there's any kind of litigation involved, or if maybe there's something you signed beforehand that says that you understand that could happen. But that's, from what I understand, that is what happened. But margins and options and stop losses are ways to kind of put your investments in a particular range, so that if it were to go above a certain price, you would maybe not purchase it or not purchase additional shares. Or if it were to go under, you may prompt your account to automatically sell it before it goes any lower than. Does that make sense?
Yeah, I guess so. From my understanding, for options trading, it's equity within a stock. Is that sort of one way to explain it? Like if Tesla's $400 and I'm betting it to be, I don't know, $600. I don't know. I have a very beginner level of options, but yeah, can you explain that further?
I mean, to be honest with you, it's an advanced feature that we don't even do a whole heck of a lot with. But yeah, so I mean, you're kind of betting within a margin, so to speak, of what, say Tesla has, it's hard to explain. I'm sorry. But if they have a particular value within their stock, you're basically betting on it to not go above a certain or not below a certain, and you're betting on purchasing a certain segment of it if it were to go in the range that you've basically betted on.
So I guess essentially in the 1 level, it's betting on stocks, right?
Absolutely. Yeah, and that's why we don't really do a whole lot with it, because it's not really, it's betting, it's gambling, which some people like to do on their own for fun, or they may have a day, in the old days, stock traders used to do it all the time, and you'd get phone calls all day long, make this trade, buy that trade. But in this day and age, we really don't do a whole lot with that, because it's been known over time and through statistics that the best way to really get ahead is not to try and time the market, but to create a diversified portfolio and just let it work for you.
Kyla has another question. If you were to invest via a financial advisor, what would our experience be like? What does the financial advisor help us do? And are there fees associated with that relationship?
Okay, so it depends on what you want that financial advisor to do for you as far as fees go. But typically when one first visits a financial advisor, we usually will sit down and there's some questions that get asked depending on why you are going to that financial advisor in the first place. Are you starting to create your own financial plan? Are you trying to pay down particular debts? What are some of your goals? What are you saving for? And then we would review based on those answers, solutions that would fit what it was that your goals were or had in mind. Many times I put together what's called a financial plan for people that come to see me. And there is no fee for that. We just do that complimentary. It helps people to understand their current situation, what some of their goals may be, and how to get to and achieve those goals. As far as fees go, the fees that are involved tend to be depending on what it is that we are looking to do. For example, our guided wealth portfolio, which you've seen, is our RoboAdvisor. And our RoboAdvisor comes with either me or another financial advisor to be your personal financial advisor, to get to know you, to understand what some of your goals are, and to share with you along the way any ways that we might be able to make it work better for you. Those do come with fees. The fees for that is typically what we call 85 basis points, which is 85% of 1%. And that's a lot lower than if you had gone to a stockbroker, maybe 5 years ago at an Edward Jones, or a Merrill Lynch. But the fees and things that are involved now are different, and things have definitely changed. So financial advisors these days tend to be what's called licensed fiduciaries, which means that once we get to know you, we start to develop some solutions that might work for you and give you some options. Another option might be to have something called a mutual fund IRA, which is a mutual fund that holds within it many other funds, and it can be put into an IRA format, making it easy to move things around. But because it's within a mutual fund of mutual funds, the costs are very low. We also do something called a brokerage account, which means you just want to open up an account to purchase particular mutual funds and just leave it there, or stocks, and just let it set, forget, and then see what it does over time. The reason for the brokerage account is there aren't any other fees besides the actual purchase of whatever that mutual fund costs. Why it's a set it and forget it is because we just set it and forget it, so we only want to pay for it one time. There's also something called an advisory account, which is managed money. And what that does is for a 1% overall for your portfolio per year annualized, we can make as many purchases, trades, and move things around as much as we want with no additional fees. That 1% covers everything. So again, it depends on what it is that we develop after sitting down with you to figure out what solutions best suit you. And from that point, we come up with the solution. And depending on that solution is where the fees come in. Does that make sense?
Yeah, no, thank you. And one of the things that I've been thinking about, through this workshop, just in general with 2020, is, our country's facing sort of a pandemic. Oddly enough, though, the stock market has done rather well given everything that has gone on. And it's also been told to me, and it's very true in the aspect that the stock market is not really the true storyteller of what the economy is in our country. But as it relates to stock and investing, I've had friends debate with me saying, I would stay out of the stock market right now during a pandemic. Like, this is not the right time. I'd go out and wait until after sort of a vaccine. So for people that are thinking about investing, does that matter in terms of timing? Because
I don't think so. If anything, I have some of my clients calling up, throwing more money in, because they realize right now it's so volatile that when it hits that down, we purchase because everything's on sale. It's like a clearance sale right now, right? Because the past 3 weeks have been all time. I mean, they've been rocked these past 3 weeks because we have the election coming up. And so right now is the perfect time to be buying in. Eventually the market's going to come back. And when it comes back, you would have bought it on sale. At least the way and if you read up on it, if you purchase it now, I mean, everything that I've read is, even though we have some rocky times ahead, by 2021 things are going to start to level off, and once they do, things come back. It's similar to, I mean, if you look in historically, 2008, it crashed. The market crashed, and there were a lot of people that took their money out of the market, which was a big mistake because, if you had 300,000 and your 300,000 all of a sudden overnight turned into 200,000, and then you sell it all and take $100,000 loss, if you had left it there by 2010, we not only gained back what was lost, but we had more on top of that. So the market is cyclical, and unless you have a short time horizon, you will always gain more in the market than not in the market. So for people who are of a younger age, professionally, and they're just looking to put away money for the long haul, to me, now is a great time to invest because things are volatile. And if you can get in at a low price, eventually it will come back and then garner you more in the long run.
Yeah, okay. So Sherry, I have one last question for you. And again, thank you so much for your presentation, your knowledge, sharing with us today. So millennials have been entering into the stock market, even more so, I guess, during the pandemic. Maybe some picked it up as a hobby, or some have realized like, hey, maybe I have extra dollars, or maybe some use their stimulus check for it. I mean, there could be a number of reasons. And there have been, I've seen articles in investing talking about sort of the impacts of the younger generation with the stock market. And the quote unquote Robin Hooders being negatively stereotyped in a certain way. So I want, or positively. So I wanted to sort of ask you, what do you think if any, the impacts of the younger generation is having on the stock market?
I think, well, not only the younger generation, I think also the Gen Xers and down. And the reason being, I think, with the stock market is people understand it now. I mean, years ago, during when like baby boomers were, say, your age, right? The millennial age of today, most of their parents didn't understand the stock market. It was for the rich. You needed a minimum of a huge amount of money just to even speak to a stockbroker. You couldn't purchase it on your own. Banks didn't even have people in it. It was like a Merrill Lynch or a Morgan Stanley, and there was a significant cost to that. So the average Joe or average Jane didn't know anything really about the stock market, and they just thought of it as something for rich people. But what happened over time is, back then when they retired, they had pensions, right? So they didn't think about 401ks. They didn't think about IRAs. They didn't have to, because they had a pension. And when they, got older and they retired from that company took care of them. And that's all they had to worry about. And they had a pension for life. Well, what happened was back, in the 90s and then the early 2000s, the stock market took a few crashes and, people had 401ks, which is different. It's not the same as a pension because companies couldn't afford to keep people on a pension anymore because people lived much longer. Pension system originally was put into place when the average age was 68 years old. So nowadays you have people on Social Security, you have people, on retirement, and they're living till their 90s, some over 100, some golfing until they're 100, And so what the companies had to do is they had to come up with 401ks. Well, since everybody has the retirement savings in a 401k, and the stock market took a few huge hits and left people without the ability to retire when they expected to, people have taken a lot closer notice to their 401ks. People watch what it's doing. People know what they're invested in. People know what their gains have been, how risky they are. This is all stuff that everyday people now have to pay attention to. So I think that, along with the fact that you do have millennials. You do have younger people, who know how to use the apps, who can use the apps. There's tons of advertising, free trades on this app or free, this on the other app. And it's a great place, I think, for learning. I mean, I just love talking to some of my friends at the bank who are millennials, who are learning, and you could tell they're excited by learning. And they're doing it all through these apps, which I think is incredible. So I think that has a lot to do with what's going on with the stock market right now, and how the stock market really has not been affected by COVID the way we would have thought it would have been. And I think people understand that the market sometimes goes down, but it comes back. During the Great Depression, people got scared when it would do that, and everybody took their money out and the whole economy crashed. Whereas this really honestly just sent it a little bit volatile, but it still keeps coming back up. Today was a green day for the Dow and the S&P. It's not affected, I don't think, the same way, because people understand it, and because they understand it, they're not as afraid, and because they're not as afraid, they're not pulling their money out the first time they see something drop.
Well, thank you so much for that insight, Sherry. Sherry, how can people who are either watching with us now or will stream the video later, how can people get connected with you if they want to further pick your wisdom?
Well, anyone can reach me anytime they want. I currently work at the BankNewport in East Greenwich, but I do handle all the ones on what we call the West Bay side. So I handle them I handle the branch in downtown Providence, Johnston, Narragansett, and North Kingston. So if somebody wanted to get in touch with me, I could answer any kind of questions that they'd like. I can be reached at 401-829-9502, or you could call any Bank Newport, and they would certainly put you in touch with me. But thank you so much for having me here, and allowing me to present.
Thank you. Thank you. We'll catch you at hopefully another sort of presentation that we can have around financial literacy.
Awesome. Well, thank you so much there, Travis.
So thank you all for everyone who either streamed on Facebook or watched this video down the line after. We hope that this provided some useful information about just sort of investing if you're in that beginner level. And yeah, we hope that you sort of take advantage of sort of this knowledge. And again, if you have the ability to go out and invest, make sure you do as much research before you go and do that, because we don't want you to lose money, and we don't want you to become less financially stable here in Rhode Island. If you want to be part of Millennial Rhode Island, you could check us out online at www.MillennialRI.com. We're on Facebook, Instagram, and Twitter. And please be on the lookout for future Adulting 101 workshops with financial literacy with Bank Newport. We'll be doing home ownership, how to start a business, and other exciting topics. Thank you so much, and have a good afternoon, everyone.